This is a market right now that seems to be trying to find some footing. Do you expect any kind of positivity in the early part of 2023?
Good morning, Donna. Thank you for having me back. And please don't shoot the messenger, but we expect there's going to be continued volatility, really driven by the Fed, Don, especially as we start 2023. We expect that earnings are going to be choppy as well through the first quarter. So when we see a pause, Don, when we see the Fed begin to pause, likely in that March to May timeframe, we think the market gets some footing, but we are not overly optimistic on the start of the year.
Greg, how bad does it get in the first 3 months of the year before a hypothetical scenario where the Fed even has a chance to think about perhaps slowing things down?
Yeah, so this is Fed is telling us what they're going to do, and then they do it. And so we believe that despite the slowdown you're seeing in things like auto sales and housing sales, we continue to see a strong labor market. That will keep the Fed focused on raising rates, at least into that February, March timeframe. Most of the damage has been done, and I think it creates a real opportunity, especially in the muni bond market. But again, we don't believe the market's going to be in this bottoming process likely till the spring, and then we're probably in a muted return environment.
Oh, so I mean, Greg, this is interesting here because you're not the first financial advisor to bring up muni bonds or bonds in general. Do you think that bonds are a better investment in the coming year with yields where they are than stocks are?
I wouldn't say the coming year, Tom, but I'd say the coming quarter. For investors looking to put cash to work, look, right now, 1 to 10-year muni bond ladders yielding about 3.25%, 3.5%. That's almost 5.5% on a taxable basis for those in the highest bracket. 1-year treasuries paying over 4%. And the important thing is, if the data points continue to slow, we can see down the Fed lowering rates in 2024, which means now's a good time to be locking in those muni yields.
Okay, now that's the muni bond side of things. I wonder, in our last few moments here, let's talk about the equity markets as well. Is it still the value trade versus growth? Is it still quality over some of those kind of more interest rate sensitive sectors out there? Where is the stock portion of your portfolio going towards right now?
Right. So we think you have to be really careful here, Dom, and drip money into high quality dividend growers, cash rich, high quality dividend companies. We don't think tech or telecom, healthcare, consumer services are coming back till the Fed stops raising rates and credit markets begin to stabilize. That could be several quarters out.